Hi everyone, I'm Russell Muldoon from Montgomery Investment Management and welcome to this week's video insight. Well, recently we've been hearing a lot about green shoots, or signs of an economic recovery emanating out of the United States. An improving housing industry, better factory utilization, the PMI signaling expansion since August last year, for example, may mean that this recovery has some legs. Despite nearly 10 months of green shoots and improving commodity demand from the largest market in the world, however, Montgomery's CEO David Buckland pointed out late last week that calendar year to date we have seen large declines in various commodity prices. Copper minus 16%, aluminium minus 15%, for example. The prices of shares in Australian resource businesses, as represented by the S&P Small Resources Index, are therefore down almost 50% in the last 12 months in response. Now, despite these large share price falls, and even if we see green shoots and an economic recovery in the US, we remain very cautious on the prospects for commodities and Australian miners, given that our view is that the next 10 years is going to look very, very different to the past 10 years. Let's take a step back for the moment and consider the very simple fact that over the past decade, China has accounted for a large proportion of the increasing demand and prices in pretty much everything. That's everything commodity based. Between 2001 and 2011, China accounted for nearly all the global demand growth for oil, iron ore and coal. Indeed, as the rest of the world fell into an economic hole, China's demand picked up the entire surplus and additional supply in aluminium, nickel and copper. In 2012, stunningly, China's share of global demand for steel sat around 50%, the highest ever on record. Not bad for a single country that represents just 11.5% of the world's GDP. Was this ever sustainable? As can be seen in this chart, demand growth over the space of approximately 10 years resulted in resources growing to occupy 45% of the Small Ordinaries Index. But prior to their decade-long run, however, resource businesses made up only 10% of the index. Now, it doesn't take much of an imagination to realize that a return to historical weightings before the bull run would mean that despite having halved in price already, resource businesses could yet halve again. Just think about that for a moment. Now, we think investors need to understand that China is an economy going through a significant transition from investment-led growth to consumption-led growth. Consumption-led growth obviously being significantly less commodity intensive. In recent weeks, the clampdown by China's central bank on their shadow financing market, which has been responsible for a considerable amount of the funding for fixed asset investment, is telling of what may lie ahead. Now, our concern is this. Despite a pickup in the likely demand for commodities from a US-led recovery, the continued falls in commodity prices stems from the slowdown in demand from China, which is greater in magnitude than the gains from the US. That's pretty simple mathematics. Meanwhile, despite the shelving of billions of dollars in capex expansion projects, global commodity supply continues to expand at an alarming rate. The result of higher supply and net declining demand are going to be continued lower commodity prices and ultimately lower share prices as margins of miners continue to get squeezed. While our view is that we might soon see a 2 in front of BHP's share price, our cautiousness is not universal. Australia has many other high quality businesses in the healthcare, internet and telecommunications sectors, which is where we are choosing to allocate our research time and efforts. Well, that's all for me this week. I hope you enjoyed this video insight. Remember to check the blog for our daily insights and please continue to follow us on Facebook and on Twitter for regular updates. Have a great week.